Greetings, friends. Episode 62 of the Financial Game Special Edition. Ferdinand Ruano, as always, Jose Miguel Crespi. In this episode, we're going to talk a little about real estate. Good morning, Jose.
Here, Ferdinand, get yourself ready. We're getting close to the end of the first half of the year. 2026 has gone by so incredibly quickly. It's flown by.
Yes.
As we mentioned in the previous episode, we had a collaboration with the podcast Más Allá del Elemento, hosted by Dr. Jean Carlos Cruz. We're going to be sharing 2 new episodes with him. And also, given the circumstances at this very moment, we keep our Venezuelan brothers in our prayers and wish them a speedy recovery because of the difficult situation in their country during these tough times. So, right, that's something we all carry in our hearts and minds these days. But we keep moving forward. Ferdinand, this episode is very important because real estate is still a hot topic. This morning, in fact, on CNBC, they interviewed a gentleman who apparently has been a permabear his whole life. I had never heard of him before. I heard him for the first time this morning, but apparently he's always been a permabear.
Graham?
I am just not used to...
Graham.
I'm not used to listening to people who are pessimistic all the time and permabears.
No.
Right? I mean, one should listen to him, right? Just to see the different angles. It's always good, but I'm not used to it. Doing it, okay? Actually, it's the opposite for me, I think. I consider myself a permabull. I always believe there's opportunity somewhere, always. So, but I was listening to him talking, right? These guys tend to talk about bubbles and when the markets are at a top and when there's a melting top and all that kind of stuff. And they asked him about the current real estate market, and well, he gave the typical response to how explaining that valuations in real estate are also extremely tight right now, and so on and so forth, right? Well, as I always say, you see, we actually have, some really exclusive inside information. As I say, inside, why? Because Ventas is in the development business. It's in the business of construction and receives very fresh data. So Ferdinand, what are you seeing? What are you looking at now? If we say, well, we've gone through 6 months of this 2026, how are you seeing the real estate market?
Look, the market, at least in general, I'm going to talk about. The real estate market has remained stable, resilient, and it is quite simple. There is really a significant need for between 4 and 7 million units of deficit that currently exists. A significant number of residential properties are supposed to have been fully built and completed by this specific date. However, you currently have a challenging situation where there is a severe shortage of new housing inventory available. Furthermore, you have mortgage interest rates that are now much higher than they ever were before the pandemic. If you look back to the period before COVID, rates were sitting comfortably at around 3.5% or 4%, but now they have climbed significantly to 6.5%, and in some specific cases, they are even reaching as high as 6.75%. That makes affordability, accessibility, the monthly payment, when you calculate the PITI, which stands for principal, interest, taxes, and insurance, that's why it's called PITI. So from 3,000 pesos that you used to pay, now you're at 4,200, 4,300. At the same time, prices aren't going down. So, as we discussed, you have the phenomenon, which is the detailed article that will be officially sent out to all the participants of Sales and Flat Services, Panorama, and the various other companies we currently have in our portfolio, where we will be sending that specific article explaining in great detail that we have a very highly segmented market that requires a specialized approach for each sector. That article mentions that within the reality I just described, you also have to consider the fact that there are people who already have mortgages on their homes which are appreciating. These people are sitting on a very substantial amount of equity, paying interest rates of 3.5% or 4%. And those people are simply not going to sell their homes anytime soon.
That's anchoring.
That's the locking effect. So on the other hand, you have exactly what this specific bill was trying to achieve, which ultimately and completely fell apart in the end. It was actually trying to address that issue. Yes, interest rates are certainly a very important factor to consider. But I really want to tell you that there are many different programs available right now where if you offer the right incentives to fix the problem and the mismatch between supply and demand, what is commonly referred to as the supply side, by making it much easier for builders to construct new homes, giving them fewer and fewer obstacles in the permitting process, and giving incentives to that new buyer with programs like the one, look, Jose, I actually have one right here, where the person has a loan of $319,000 simply for being a dedicated member of the armed forces. They are being given $50,000 in down payment assistance. And that down payment assistance comes in as a second mortgage with absolutely no interest at all. No interest. And it is fully amortized over a period of 30 years. And you only have to pay it when you sell the house. But you don't have to pay, no, there's no amortization.
You pay it with the equity you generate.
With the equity that you build up when you go to sell, yes. Or even if you decide to refinance. And some of these specific programs, I really want to tell you, Jose, in certain states like Florida, they offer them as grants. A grant is forgivable. It's a loan that as long as you stay a certain number of years in that property is forgivable. It is forgiven after you meet the term. All those programs exist right now.
Ferdinand, one of the news stories that has made the most noise in the market in general is the significant acquisition made by Berkshire Hathaway, a move that has certainly drawn a lot of attention from investors everywhere lately.
Right.
Of a home builder in the United States, Morrison Homes.
Taylor Morrison Homes.
Taylor Morrison Homes. So
it was for $8 billion. I believe it was actually almost $7 billion in cash. I mean, it is quite a lot of money, okay?
Why?
To provide a clear illustration for everyone watching, Berkshire Hathaway, led by the legendary investor Warren Buffett, is quite possibly the most remarkable and enduring success story in the entire global landscape of financial investments today. Because the one who created it was Charlie Munger and Warren Buffett. Warren Buffett is the investor who has created the most wealth. Elon Musk is up there, but Elon Musk is an entrepreneur. I'm talking about a money manager.
In identifying
opportunities.
He is the best in history at identifying a company.
Ahead of the game.
Ahead of the game and getting involved early, right? Participating and being part of it. He's always believed in that ownership. The idea that when you invest in a company, it's because you believe in its model and want to be an owner.
Yes.
Of that company. Why do you think a company like Berkshire Hathaway, which we've mentioned has consistently been the best at identifying investment opportunities, said, with everything that's been said about real estate and all the negative economic outlook that sometimes gets painted given the affordability situation and so on?
What made them decide to write an $8 billion check to acquire a home builder?
I'm curious to know, what did Berkshire Hathaway see? What did they see in the residential home construction industry to get involved in it like that?
There are three factors, the ones I always talk to people about: adaptability, consistency, and total certainty. Adaptability, because the home builder has the ability to adapt their designs while maintaining their profit margin, no matter if the market goes up, down, or stays the same. Consistency, because there's no doubt that what people want, their biggest investment in life, is their home. And there is a sense of certainty, because we know for a fact there is a massive shortage of 4 to 7 million new homes. And that is not going to be solved in the next 10 years. And that is certain. It is a reality that no one can easily break or change. I mean, in that sense, well, interest rates certainly play a major role in this equation, but let me tell you something important. For example, if you talk to someone in Miami who has $500,600,000 in equity in their home with a quality of life where now insurance costs are eating them alive. Because now the insurance company for any roof over 15 years old makes you replace it first. You have to replace the roof, which is about a $25,000 investment just so they can insure your house. That's the level we're at. If you get into HOAs, especially with what happened in Surfside, and soon the 40-year certifications, which are basically hidden assessments for condos, then you have a situation where the HOA, with rising expenses and insurance premiums, becomes an extremely challenging and difficult situation for you to manage. If you offer someone a brand new house built to Florida's 2023 building codes, which are exceptionally strict, where it can easily withstand a Category 5 hurricane, where you have the chance for a significantly better and newer lifestyle, and where insurance costs will be much lower. According to our studies, there's almost a 50% difference between a resale unit and new construction. So Berkshire Hathaway says, supply and demand makes sense to me, adaptability makes sense to me, profit margins make sense to me, the rest we can achieve. Because look, historically the reality is that mortgages have been between 6 and 6.5%. That's the reality. What happens is that the problem is that of course it's 6.5%, remember, on the average price of a $240,000 unit, which was the average over the last 10 years. But if you have 6.5% interest now, on an average of $450,000, plus the insurance costs with the climate situation, then you have a whole different scenario. If we can build houses that are resilient, that are well constructed, that offer a better lifestyle with much higher ceilings, reinforced roofs, block and cement, foundations raised almost 9 or 10 feet to prevent flooding, then I think that's better than a resale built to much lower standards. And if you can buy it at 75, which is only 40% of what you currently pay for a resale, then it makes perfect sense. Especially if you add specific programs that try to help younger generations, mainly those who work remotely, from their homes or other remote locations. That's another factor. So let me repeat that for you. Adaptability, consistency, and a sense of certainty. I think all those factors are what have made them pay attention. Also, besides that, there are currently several programs available that are help you in the transition from being a renter to becoming a homeowner. And there are options to make that possible. Regarding the recent trend of sales going down, the average used to be around $1.7 million per month, but now it has dropped to just 1.5. Yes, of course, there is absolutely no doubt about it at all. I mean, just trying to buy a brand new home in this market now costs several millions of dollars. But if you can bring an affordable, accessible product to the market, there is no doubt in my mind that Merchant and Hemingway's bet is either build to rent or build to sell affordable. And I truly believe that is exactly where the core idea and philosophy behind this entire project comes from. Besides, it is becoming clear that in the current housing market cycle, there will inevitably have to be a situation where the government authorities will have to intervene.
Go back.
Well, I want to tell you a certain something.
See what happens.
The final vote on that specific bill was so remarkably clear and bipartisan.
It's completely bipartisan, I mean to say.
Because look, if you just take a moment to look at this entire situation. You have major national elections coming up very soon. One of the primary issues that has been talked about constantly in the media is the critical matter of inflation, the rising cost of living, affordability, and general accessibility in terms of daily necessities, of affordable housing. The bill specifically aims to, in fact, Jose, it tries to strictly limit and regulate the involvement of large institutional investment funds. You know that when you were at one point trying to buy a new home, you would come in and then one of these big moguls would show up, of course, under another entity, and make a cash offer. And the guy would say, well, look, Jose, I'm really sorry, but...
Cash is king.
Cash king.
Funds ready.
I have to move on. Well, anyway, if I have something else come up, I'll let you know. So they also tried to give priority to that primary home buyer. I mean, it was a hugely important bipartisan bill for housing. I don't know what's going to happen. We have to deal with that. But regardless of the current political climate or the general economic situations we find ourselves in, there is a persistent market demand. There is a clear and present need to supply the market and a vital need to provide consistent inventory. I truly believe it's going to happen under some very interesting terms and conditions when the right time finally comes. To be honest, I don't think interest rates, Jose, are going to go down anytime soon. It would really surprise me if they did, and it would be a big development. In fact, it would be a huge benefit to everyone involved in the sector.
Of course.
And demand is going to increase. There's no doubt about that. However, the reality of the situation is that you have a number of factors. The Fed in its official statement clearly said that they are going to remain committed to their path. They're going to maintain that 2% target. Current inflation levels are still holding above 3%.
They look a lot at the PC.
Right?
And the PC, well, it came out, the latest economic reading just came out, and it was actually a little bit high, coming in at 4 or 4.1%. So, yes, we currently have a Federal Reserve that is going to maintain that firm stance that as long as the incoming data doesn't show clear evidence that we can move on to a path of lowering interest rates, they're simply not going to do it, right? We talked a little bit in the previous episode that this wasn't maybe exactly what the president wanted with the recent push to put Kevin Warsh,
Of course.
like at the head of the Fed, but really that's the mission. That's the mission of the Fed. I elaborated, and I'll repeat it. What I think is that there are certain signals at certain points that I believe could mean that that peak of inflation, right? If you look at the headline now, it will tell you that inflation just hit a 3-year high in the United States. Okay, right. That's the headline news right now. But I think there are certain signals, especially if we see that energy costs remain steady again. If they stabilize, it could help. It could help. And we see that when we look at the core, which we talked about in the previous episode. So Ferdian, I closely monitor the real estate market. I remain, as I always tell my people and the clients who seek advice, there are smart and strategic ways for you to place your capital in real estate that has good collateral, that has a solid long-term future, right? Looking at it a bit more long-term. The market in the end they're cyclical, right? And even if the turn in the cycle is it becomes a bit slower, at some point we'll get there. And that's how I see it.
Well, look at it from the following perspective, if you will. I mean, just look at it as a diversified portfolio made up of stocks, bonds, cash, and fixed income instruments. Typically, in a scenario where inflation is relatively moderate, because we are currently in a period of moderate inflation, tangible assets with control tend to significantly outperform and maintain a high level of consistency. Furthermore, they actually decrease the risk in any analysis you might want to do, whether it is a Monte Carlo simulation, a Sharpe ratio calculation, alpha, or really anything you want to do in terms of all these different modern portfolio theory statistics. When you add between 15 and 20% in a diversification of tangibles, I'm talking about real estate, which is an asset that has appreciation, income, and in general, the potential to be anti-inflationary. There's no doubt it makes sense.
Of course.
It doesn't matter if rates go down, if rates don't go up, if you're a builder, if you're not a builder, it doesn't matter. It's always a good placement.
In the near future, we will be producing an exciting episode on exactly where the latest new development projects are located throughout Southwest Florida. We are going to go to Cape Coral, and we'll probably be in a model home by Pentas Homes. And the idea for that episode is maybe to have a guest, a contractor who is working closely with Pentas, to talk a bit about their marketing, how Pentas is moving its inventory, how Pentas is focusing on what they call affordable luxury, what affordable luxury means, and why today it makes sense. So stay tuned, keep following us, give us a follow. If you like this content, share it. And thank you for tuning in to El Juego Financiero Special Edition.
We look forward to seeing you in the next 2 episodes, if God wills it so. So I truly hope to have you join us once more on El Juego Financiero Special Edition.
Until next time,